If you've ever wondered how to spot fundamentally strong stocks, the kind that holds up in market volatility, delivered constant profits, and manage debt responsibly, this lesson's for you. Today we're breaking down the financial health score, a single, data-driven number that captures a company's overall financial resilience at a glance. We'll explore where to find the score and how it works. 2. How to interpret the scores. And 3. What are its main building blocks. So let's dive in. Finding a financial health score is easy. When you open a stocks dashboard on Investing Pro, one of the first things you'll see is the financial health score, a number between 1 and 5 that gives you a quick read of the company's financial strength. Here's how to interpret it. A score between 1 and 1.5 means weak. That's the bottom of the scale, and it signals serious financial strain. Between 1.6 and 2.5, the label is fair. It means there are some weaknesses under the hood. The company might be carrying too much debt or is struggling to generate steady profits. If the score falls between 2.6 and 3.5, that's already good, a sign that the company is generally stable and managing its finances reasonably well. It's the kind of middle ground that risk-aware investors often find attractive. A score between 3.6 and 4.5 earns the label very good. This is where you find strong, financially healthy companies with well-managed balance sheets and consistent performance. And finally, a score from 4.6 to 5 means excellent. These are top-tier companies with exceptional fundamentals. With low risk, high stability, they're exactly the kind of profiles that institutional investors love. Now, whether you're looking for deep value turnarounds or steady blue chip plays, this score helps you quickly filter for risk level that matches your investment strategy. Think of the financial health score as a composite diagnostic, not a rating, not a signal, but a weighted summary of core financial resilience. The score ranges from weak to excellent, and it aggregates several financial categories: balance sheet strength, return metrics, liquidity, growth stability, and in some models, even elements of price momentum. A high score implies a business with sufficient liquidity, capital structure, discipline, consistent cash generation, and sustained profitability. It also implies that the price is not overexpensive. A low score may flag a capital structure imbalance, margin stability, or exposure to short-term financial shocks. This design reflects long-term survivability. It rewards balance sheet strength and durable cash generation over flash-in-the-pan rallies, for example. That said, these weights vary slightly by region and sector. For example, capital-intensive firms in emerging markets may skew lower due to structural leverage, while cash-rich tech firms in the US often dominate the high end. The first building block of the financial health score is balance sheet analysis. A company's balance sheet analysis is where real diligence starts. The score emphasizes metrics like debt to equity, which captures capital structure leverage and risk asymmetry during downturns. Current and quick ratios, which expose liquidity gaps if the company's obligations come due faster than cash flows can respond interest coverage. Now, these are new to seasoned investors, but the weight here is important. Most scoring systems prioritize solvency over growth for good reason. Capital markets are quick to reprice balance sheet fragility in stressed environment. Companies with high balance sheet scores can absorb shocks and finance growth without dilutive issuance or distressed refinancing. The nuance, of course, is the context. Leverage is not inherently bad. Capital-intensive models like utilities or telecoms naturally can carry higher debt loads, so use the score as a context-aware filter, not a universal judgment. The second building block is profitability. The score factors in profitability, but with more granularity than just net margins. It captures return on equity, ROE, and in many cases, return on asset, ROA, and return on invested capital, ROIC, depending on the data set. What you're looking for is not just high returns, but stability across time frames, and if those returns are achieved with or without excessive leverage. The financial health score reflects this balance by integrating both profitability and capital structure. And while net margin is part of the mix, sophisticated investors should examine whether margins are expanding or contracting, and whether those changes stem from operational efficiency or one-time items. The third building block here is liquidity. The financial health score gives meaningful weight to the current ratio. quick ratio, and in some cases, even the cash ratio. These metrics help assess near-term solvency under a no-growth, tight credit scenario. While our current ratio less than 1 is a textbook safe, seasoned investors know that sector context matters. A capital-light software-as-a-service firm with recurring revenue can run leaner than, say, a retailer managing seasonal inventory swings. Where liquidity scores matter most is in early cycle screens, especially for fighting companies that can survive macro tightening without fire selling assets or cutting core growth spending. The fourth building block here is the growth quality assessment. Now, alongside profitability and the balance sheet status, this score looks at EPS growth, net income growth, and multi-year CAGR patterns, because the consistency matters more than occasional spikes. It's also important to assess how growth is being achieved. If net income is growing faster than revenue, it may signal spending margins or operational leverage. But if that trend reverses, you need to ask why. For long-hauling investors, this part of the score helps filter companies with quality growth, the kind that supports premium multiples over time. So there you have it. To sum up, the financial health score is a way to assess which companies deserve your deeper attention and which ones don't clear the bar. For experienced investors, it offers a reliable first glance to filter for stability, quality, and resilience. But as always, the real work begins when you go beyond the score and ask, what's driving it? And is it sustainable? Thank you for watching.